Good evening, ladies and gentlemen. A very warm welcome to all of you and our distinguished panelists who will be discussing perhaps one of the most critical issues that is linked to the very survival of this planet. That is accounting for the value that businesses create and the costs of creating such a value. Can we change the way management accounting is currently done and capture the total cost of operations? We at the IIMB Center for Corporate Governance and Citizenship are happy to trigger off this debate with a very distinguished panel moderated by Professor Vasanthi Srinivasan and Professor P.D. Jose from IIM Bangalore. The IIMB Center for Corporate Governance and Citizenship, which is a center of excellence accredited by the National Foundation of Corporate Governance, sponsored by the Ministry of Corporate Affairs. The center is primarily engaged in 5 distinct areas, that of research, teaching, training, advocacy, and dissemination in the fields of governance, ethics, CSR, and sustainability, thus covering the entire canvas of responsible business. The center has an advisory committee from IIMB faculty, comprising Professors Padmini Srinivasan, Anil Suraj, and the 2 professors you will see on stage, Professors Vasanthi Srinivasan and P.D. Jose, and the chairman of the committee is Professor Reggie George, who is also here with us today. So without much further ado, I am inviting the members of the panel to come to the stage, and I hand over the proceedings to Professor Vasanthi, and I'm sure we'll have an enriching evening. All that we ideate today will be captured in our portal, www.teachcsr.com, and we invite you to kindly register free of cost and visit our website. Thank you.
Good evening, ladies and gentlemen. My pleasure to welcome you all for this panel discussion. I just want to take a few minutes to set the context for today's discussion. Over the last few years, at the center, most of us have been asked questions from different stakeholders around how do you measure social impact. The first of the questions actually came from a funding agency which said, how do I know that every penny that I am actually supporting an initiative with is actually creating the kind of social impact that we desire? On a completely different note, there was a group of chairmen of public sector banks asking us, how do we know that public sector banks have indeed created value for every penny that has been spent or that has been raised? So what are the ways and how do we actually measure? On a completely different note, we were asked by the Urban Affairs group what was the social cost of the IT industry for Bangalore. At a level, it's interesting that there seem to be many more stakeholders today who are asking us the questions related to social value, social impact, call it by whatever name, but definitely there is this increasing question related to spend to the value. So it's no longer this traditional notion of just financial accounting, but somewhat a more comprehensive way of being able to talk about what it is that business is doing. So in a way, today's session is kickstarting, hopefully, a more meaningful and a deeper conversation on how do we know that all of what we do in the social impact is actually adding value, and how does this value actually translate in terms of transformation from a sustainable development goal perspective. Okay? So what we have is a absolutely incredible panel. Okay? Couldn't have asked for anything better. So let me take a minute to just introduce the sequence of this evening. We begin with a presentation on social value accounting from Jeremy Nichols, who's the founder and chief executive of Social Value UK and Social Value International. A chartered accountant by training, but with a deep interest in social entrepreneurship and an acknowledged expert in social enterprise, who better than Jeremy to set the context for this conversation. Thank you, Jeremy. Wonderful to have you with us here. Okay. And after Jeremy's presentation, we will have stories from the field. In some sense, the people who actually battle it out there on that war-torn area. And I'm going to call upon Sandeep Srivastava after that, who's the Senior Vice President, Corporate Environment and Sustainability at Ambuja Cement. Leads one of the biggest climate change and sustainability consulting teams in South Asia. And all of us know how much their industry runs into problems every time we have a session on sustainability or environment. And so it's interesting the kind of conversations that we are going to have there. And after that, we are going to have Santosh Jairam, who's the partner and head sustainability and CSR advisory KPMG, who has a deep interest across looking at product sustainability, sustainability reporting, climate change. And in some sense, Santosh will actually be able to build on Sandeep's presentation and provide some insights. After that, we will have Narayan from Wipro, who's the Vice President and Head of Sustainability Programs, and who actually has been quite an anchor in creating Wipro's sustainability initiatives, and will speak about their experiences with sustainable social value accounting. And last but not the least, I'm going to invite Jose to be able to kind of wrap up and provide his views and comments, okay? Hopefully, given this tone, voice of mine, I will do very little talking. It's only moderation in the truest sense. Over to you, Jeremy.
Didn't keep you away, but the future sustainability accounting, a paradigm shift in management thought is quite a mouthful. So I want to kind of cut through that a little bit. I am the Chief Executive of Social Value International, which is a membership organisation. We have members now throughout the world, about 40 countries, and they're all people, cross-sector, private, public, social enterprise, non-profit, people who are interested in this question. How do we more effectively account for the value of our work? Obviously, this is a growing area, and I want to talk a little bit about where I think that's going to go, as much as where it is now, what's next in that. But can I just check, how many accountants do we have in the room at the moment? 1, 2, 3, 4? It's about 5 or 6 of us, yeah? Way. Good, because this actually is a conversation about accounting, and I'm firmly of the belief, and you might find it surprising, that it's accountants that are going to save the world, and accountancy. See, why does that always happen? No one seems to believe it, but yeah. I hope that you might see a little bit more about why that might be. Now, let's start with a bit of history. This guy, anybody know who this is? Particularly the accountants should. No? Okay, so he's called Luca Pacioli. He's a Franciscan friar around in the 13th century. And this is the person who wrote the first accounting textbook. So you've got him to blame. If you're kind of worried about why we all sit there studying accounting now, he's to blame. And he did it at the time because of a growth of interest in universities, ironically, getting universities to be more, they wanted to know what the value was being created by the people who managed their land. And they didn't know, so they said, I know, let's invent this thing called double entry bookkeeping, and he documented it. Now, the point of that is that this is not a journey in the last 5 years about sustainability accounting. This is a journey of our society across the world thinking about how we become more accountable to each other in everything we do. And it really kicks off here, but it does move forwards a bit. And I just want to, shoot on a little bit on that to think about where this all really then kicks off is late 19th century with the limited liability company, the growth of investment, largely through fossil fuels, and a massive boom in money flowing into activities where people didn't know the people that they were investing in, and the need to have some information about what was happening with their money. And that's where this then really starts. During the 30s, we then have a massive increase in cost accounting, largely because during the war, public sector spending vast amounts of money on private contractors, much bigger than ever has been the case in history, and they don't know what the margins are on those contracts. And so this is the next big step up. 70s, then we start with environmental reporting, and now you start to see the pace of change speeding up. The 90s, we have social reporting. By 99, the Global Reporting Initiative comes along. Accountability as an organization starts. We start originally in our form as the Social Return on Investment Network, 2007. We had the first social and environmental profit and loss accounts, which we're going to see a little bit more of. People start to say we can value well-being using money as a proxy for that valuation over the last couple of years. More recently, we've now had the natural and social capital protocols released, and more recently, the Dow Jones Sustainability Index includes impact valuation as one of their criteria. That is quick now. You know, I think we have been behind the times a little bit in responding as a society to the challenges we face in terms of how we account for it, but I think you can see that the rate of change is really moving. And so just to look at a few aspects of that, firstly, reporting. And so without, I hope, stealing too much of Ambuja's thunder here, because Ambuja really kicks this off for me and was one of the early examples, and it's a fantastic example. And it was then taken up to scale by the group, so the Holcim, the holding company, then took the original work in Ambuja and went up, now obviously taken over by Lafarge. And they come up with one of these, an integrated profit and loss statement. So this is accounting. You know, this is people putting the information about social and environmental information in one page, not an 80-page sustainability report, although you can read the background if you want, but it summarizes it. It summarizes it in a way that is transparent and that we can think about what's happening in there, we can analyze it, we can make judgments on it, and it is fantastic because it's turning this information into management information, into the information you can give to a board and they can start to make decisions. That's what's been happening, and that's where I think we've got to. I'll give you another example of that, which is Kering. For those of you who don't know Kering, it's the company that owns Bottega Veneta, Gucci, Puma, that kind of high-end clothing companies. And their most recent group version of this looks like that. Now this is not a profit and loss, it's just a loss account. They have calculated that the cost of their operations to the world environment is about 750 million euros and went public with it. And they've broken this down across the main environmental impact areas, and they've gone down to their fourth tier supply chain. I think this is just awesome. And this is a direction of what's happening. But I struggle to imagine the boardroom meeting when this came up, you know, the first one of these. So item 3, the environmental loss account. Whose idea was this? What, you know, you can just imagine that would be such a difficult comms thing to come out with and make this public. But they have, and now more and more companies are doing that. You know, it's Volkswagens and Volvos, and people are starting to generate this kind of information alongside what they're doing on their financial accounts and alongside what they're doing on their sustainability reporting. More recently, I think BASF, one of my favorites at the moment, similar kind of analysis. They're looking not only, however, backwards into their supply chain, but they're also looking forwards into their customers and thinking about the other value that's being created and destroyed. And that's what's so powerful about these. They're not just statements of, isn't it all great? It isn't all great. There are costs as well as value being created by these businesses, and they're willing to recognize them and account for them and become accountable for them, and therefore we can manage them and see a future where we have lower environmental and social costs than is currently the case. That has then emerged through organizations like the World Business Council for Sustainable Development into protocols, into guidance on how we actually do that. Now, no one's saying we've fixed it completely yet, but we are well on the way to agreeing standards and basic principles which allow us to produce this information in more standard ways. And don't think that it should be perfect. When people started financial accounting back in the 1880s, it was hugely variable. People were doing very different things. There simply wasn't the consistency. It took time and took practice and sharing and arguing within a community to bring that standardization. And that's the journey that we're on, and we're doing it very quickly now. I love the fact that the Dow Jones Sustainability Index has now brought this in, this question about impact measurement and valuation, because that is another thing that will drive a lot more practice quickly. A lot of businesses who report under this will start thinking about what is the value of their impacts, the positive and the negative ones. And that practice will in itself start to help us converge on standards. I think alongside that, though, we're going to want to know whether these reports are actually any good. How do we know when people put out this kind of information? Not only whether it's accurate, but whether it has the right information in it. And so the demand for assurance, I think, will increase. We see little kind of glimmers on that. For a while, we've had international standards about assuring non-financial information, and this is the accountant's version of that. And then more recently, accountability came up with a standard called the AA1000 Assurance Standard for how do we know that sustainability reports are okay. And more recently now, our work on this is a standard very much around thinking about whether the valuations that people are using for this information, are they reasonable? Are they a reasonable way of presenting the relative size of the different impacts that people are having? Were the greenhouse gases much, much bigger than the effect on water table? How do we work that out? And so as we develop the standards, alongside that, we will develop assurance of that. The information becomes more credible. Investors are willing to take more notice of it. At the same time, I think we're also going to see increasing willingness to enforce existing legislation. Now, there's been a lot of changing legislation. We have our own here. I'm sure we can talk a bit more about that in a little bit. But this is, again, look at the words there. This brings in the question of impact. We're not just reporting on sustainable and environmental things, whatever they are. We're saying we need to know how much change have you created in the world, positive and negative, above and beyond your core business operations. That's embedded. Everyone's going to be doing that. In Europe, the non-financial reporting regulations passed into law, and everybody has to now do that. Legislation is going to drive up the game. At the moment, there is not assurance, assurance isn't mandatory within these at the moment, but it's starting to be. Germany has asked for the information under this to be independently audited, so that users of the information have enough confidence that they can actually use the information to make decisions. If we don't have that, we'll have a lot of paper being produced and people looking at it and going, well, I don't really know whether I can use this or not. What's it about? One of, I think, the really interesting things about this, though, is that there is a lot of legislation out there already that is not being used, that is not actually being enforced. A lot of the time, it's not that we need to have new legislation. If you look at most company reporting requirements, the director's responsibilities already have something in there about having to have an eye on what's happening to the wider community, to suppliers, to employees, not just to investors. It's simply that we haven't really enforced that or thought it through what that would mean. So I think the other thing we'll start to see as we get more practice on this is more push on assurance, standard reporting, and on the requirements to legislate on that. And that then is just simply part of that journey that started back in the 13th century with Luca Pacioli. Within that, we're going to want more standardized data, because at the moment, if you're looking at financial accounting, we get standardized data from transactions. People buy and sell stuff, and we know what they bought and sold it for, so we can put that in the accounts. We're not talking about things that people bought and sold. We're talking about changes to people's lives, changes to ecosystems, and yet we still want to know how important those are. And that will need other approaches to developing some consistency and standardization in those values, which has to be bottom up. It has to recognize different contexts. We can't have one value fits all. And we run a database on the back of this called the Global Value Exchange, which is an entirely open one, where you can all go on that, use it if you want, but more importantly, you can put things in it. You can put in the outcomes of your work. You can put in what you think the value of those is, and no one will stop you. And like TripAdvisor, it allows you to go in there and say, well, I don't agree with that. And that debate allows us to crowdsource, if you want, from a bottom-up experience, an alternative way of standardizing data, which continues to change over time and reflect local contexts. The more we have of that, the more practice we have, the more we'll be able to get those standards that will allow more people to make more decisions on this information. Now, going further ahead on this, I would like to see a future where, in fact, there isn't really any sustainability accounting at all. We don't want it. We integrate it back in. This line between financial and social is arbitrary. It's socially constructed. It's not a real scientific difference that we can go and test in a lab. It's something that we as society have decided, what do we put in financial accounts? Oh, okay, that. And now there's this other information that we're going to put over here in this other account. But that line changes over time and has changed. You know, a few years ago, and sort of say 2000, mining companies did not have to account for the closure costs of a mine. So they didn't account for it. And then they did. It was decided that they should put that information in. Up to that point, it had been an environmental or a social cost. It was over there. Change of what was deemed okay by us in society, and we have to put it in. And of course, the first year is a bit anarchic. 3 years later, it's standardized. We've done it. But that line between social and finance is not fixed. It does change over time. And I think the more we recognize that, the more we can realize we can push with that. And so just to show you what, for the accountants in the room anyway, the 5 or 6 of us in here who like to see numbers on tables and things like that, just to see what that might look like. That's a standard, simplified, current form of accounts. It goes, what have we got in our assets? What have we got in our liabilities? What are our reserves? That's what it looks like. And now alongside that, people are generating these integrated profit and loss accounts, which say what is the value that we are creating or destroying in terms of our effect on the society and the environment. And we're going to hear some more of those examples, and more and more of those examples will create standards. And from my perspective, I don't really want to see those two things as separately. I want to put them together. And I see no real reason why we couldn't take the environmental loss, if you want, and put it on the balance sheet of a company as a provision, which would have the effect of reducing the reserves of that company. I hope I'm not losing you at this point, because that's important, because no cash has to change hands here, but that company now has lower reserves that it can distribute to shareholders. It is less interesting to investors than it was. Money will move to those companies which, on balance, have a lower environmental impact than the ones that have a higher. Analysts, in the end, are driven by that kind of data. And so in the end, I think however much we're moving, if we have them apart, there's still a risk that it won't really drive resource allocation decisions that are being made every day by investors around the world. You know, trillions of dollars are changing hands on stock markets every day. We've got to shift those dollars if we're really going to reduce inequality and improve environmental degradation, which has got to be our goal. So I think, in the end, we've got to see how we take what we're doing at the moment and integrate it so that we can move from a position where we're currently maximizing financial value for investors, even though nobody asked you, nobody said, what do you want out of your investments? This is an assumption. We could change that as a society, and we could say, hang on, we don't want to do it that way. We want to do it this way. We want to maximize financial value, yes, but subject not to creating all sorts of damage to the world in any shape or form. And that's, I think, reflects you and me more closely than the current model. It's something we could choose to do as a society if we wanted. And if we did that, you would immediately move all these integrated profit and loss account information into mainstream accounts, and we'd have done it. And that would be it. So thank you very much.
Thank you, Jeremy. You just set the tone for this panel discussion, okay? They're straight 3 minutes from you, okay? On that note, I'm going to invite Sandeep too.
So good evening, everyone. Really wonderful to be here in IIM Bangalore. I think thank you very much for this opportunity, and also very nice to see so many of you spending your valuable time here, going through some of these topics on sustainability and sustainability accounting. I would say that really what Professor Vasantia said, that Jeremy has set the tone for this and made my life also much easier now, because I am no accountant here, once again. And also that all this number crunching has also been done by someone else in the organization, right? But fortunately, we have KPMG, Santosh is there. So he's going to validate all my data. He has no other option. Jeremy has also endorsed our work. So I think let us start. And I'm also taking a little bit liberty here, is just not confining myself to this case study about the social and environment profit loss, but also taking you through some of the very recent and interesting global reports or analysis which has come. I thought that might be interesting to you to know. So maybe just 5-7 minutes more if you can allow me, so I can just touch upon those things as well. So just before going on to the case study, I thought that let us put the things in perspective. We are one of the largest cement manufacturers in the country. We are also part of Lafarge Holcim, as you've just heard, and having a very wide network of the plants and the dealers and the customers and all that. We have got pan-India presence, as you can see, that some of the integrated plants and grinding stations which are using the fly ash from the power plants, and also having the bulk cement terminals on the western coast where in the sea the ships are moving to take the cement from one plant, and they would be taking to the hinterland where the trucks and other they have been carrying the cement inside. So that is what has been here. We have got something like 32.5 million tons of the capacity. That is the installed capacity. And these many things are there. The clinkerization is something which we do, but we also, as I said, mixing the fly ash to make the PPC, Pozzolana Portland cement, which is considered to be better because we are using the waste. But as we go through, you would also know that there are so many other kinds of waste we also use. But what is our vision? We want to be one of the sustainable, competitive company nationally, globally, that we have already enshrined in our vision statement. We also want to create the value for various of our stakeholders. But we are also, want to up the game in terms of taking it to imbibing the principles of the Global Compact. And then we are already a life member of the Global Compact Network India. Also the member of South Asian Forum on SDGs, Sustainable Development Goals. WBCSD, there is a chapter on cement, that is Cement Sustainability Initiative, and we are an active member there. Also, we are participant of Dow Jones Sustainability Index, as Jeremy has just touched upon that, and we have been participating for last 3 years in this, in the Emerging Markets Index, which has been there. And we have got very much focused when we talk about the social, the water livelihood and water, and then it has been spread all over the places, especially the places like in Gujarat, where you have got this salinity ingress. So we have got many check dams and percolation wells and all those who have created over the period of time. Though it is about 30-year-old organization, the Ambuja Cement Foundation, who's carrying out this work, is about 2 decades old. And we have got, even in Rajasthan, which is considered to be a dry area, quite a few of these water structures there. And of course, then we have got this initiative on water positive, which we started in 2012, where we have thought that let us find out where we are when it comes to water. And to our pleasant surprise, I think, again, Santosh was there at that time also, wherein we could find, and as a pleasant surprise, we could find that we have been recharging double of what we are consuming. And that was a really pleasant surprise for us, because there was no such assessment was done in previously in almost like 1.5 decades. So that was a dedicated effort, I would say, which has brought us to this 2 times in 2012. That time we decided, let us go for further on the positive side. And then last year, we could reach to 5.5. And earlier, a couple of plants, we have been saving the day for all other plants. And herein, we have got the, everyone, all these integrated plants are water positive of themselves. So of their own, they are water positive. So this was some big initiative. Another initiative which was there on the carbon mitigation. And as I said, that this blending of fly ash, which is a major lever, and the PPC production which is there. So you need not to have the raw material, which is limestone, which is getting burnt every time. You are replacing something like 30% of that by the fly ash generated by the power plants, and not just by us. Because we also have some captive power plants, but they are generating very less amounts of the fly ash. Renewable energy was focused, where we have windmills, we have small solar projects. Alternative fuels, which has been replacing coal in the kilns. And you name it, and we would be using that kind of waste in the cement industry. So if you go there and see a cement plant, many times it would be difficult to recognize, because it would be keeping all kinds of waste, whether it's a biomass, whether it's a paint, sludge, or the oily sludge, or you have got the lot many pet coke, which has been generated by the refineries. All these kind of things are getting stored there, and these are getting burned there and replacing the coal. And there we have been getting some advantage benefit for the carbon emissions. And of course, there are projects in the community dealing with the carbon, like biogas plants and so on. And another thing which was there, as I've just said, the sea transportation of cement. These are some of this is our social footprint all across the country. Not necessarily onto those sites where we are operating, but some of the sites which are actually away from there. And you have got the education centers, you have the health centers, water, sanitation is a focus area, HIV/AIDS training, and so many of these things are there. It's just given here. Better cotton initiative for the agriculture. So all of these are there. So then when it came to map our initiatives with respect to the sustainable development goals, which is 17 number, again, this was a very pleasant surprise that at least we are touching most of them when it comes to the sustainable development goals. And out of 169 sub-goals, at least we are there more than 100 of 169. That we are having some program or other in that. So this was also this mapping we have done. Then we have also said ourselves that there have to be some long-term, medium and long-term programs for 2020 and 2030. And these were in the 4 baskets, that is climate change, circular economy, water and nature, and people and community. So basically then coming from many of these sustainable development goals, and it is talking about again the sustainability concept where the social environment and of course the people, community, everyone is there in that. So and health and safety, of course, as a part of people and community is a focus area. Now coming on to this particular project, which we did to know our true value. Again, the KPMG methodology was used basically, and then it was, though is a mammoth work, because we have been working into several areas at the same time. And these are some of the drivers which we had at the time. And also we want to do certain measurement because we thought that if you are able to measure, then you are able to control, and if you are able to control, you are able to improve. And there has to be some yardstick, some kind of a tangible, the results which can tell you where you are. So this particular then exercise which was carried out, and as Jeremy has explained, it is the balance sheet where not only the financial parameters, but also you have got the economic, apart from economic, you have the environmental and social profit and loss, or the pluses and minuses there. So what are the pluses and minuses there? So you have so many things which you have been carrying out. In the environmental side, when it comes to the negative side, of course, you have the water extraction or CO2, or we also have the dust, sulfur dioxide, nitrogen oxide emissions. All these are into the negative side. Positive side, you have all these water positive things which have been helping us a lot, going for the carbon mitigation things which have been helping us a lot in terms of going on the positive side. And social is on to the improving the health, improving employment, improving the agriculture activities there, reducing the soil salinity, etc., has actually helped us in terms of when we did 2012, that this comes out to be, fortunately, you have got only like 12, 17 as the EBITDA or the profit. And then you have got the environment side, certain pluses, and the social side, of course, many pluses. And what you get is 1970, which is more than 1270. So it's more than 700 crores of net profit when we have put together all these things which were there in 2012. And we have also done for the social side, the SROI, the social return on investment. And what we could find that 1 is rupee spent has got a return of 8.5 rupee, which has gone then further on to 13 rupees in 2014 and 15. So this was for the social SROI, this 8.5 in 2012, there, and it is further more than there. And of course, then this diagram shows that some of the highly likely areas we capture, likely areas and unlikely areas. What is actually coming out, from here is that negatives you would be or tend to capture more because these are posing some risks than the positive side. So sometimes you tend to not go into very much accurate assessment for the positive side, rather than to go accurately assessment on the positive and the negative side, because that might hit you someday. And whether it's a legislation, whether it's a stakeholder concern, or whether there are other kind of drivers that may be putting you in place, and that is why you would be more concerned about that. That we also learned. So what we did then, for having little longish kind of a assessment, that when we do the assessment for the risks, and especially dealing with certain legislation that might be coming for, like the PAT, as you may be knowing, for energy efficiency, renewable energy, purchase obligation, and some of the things might come for water. And of course, the standards have come for NOx, SOx, and dust. So these three parameters we have taken just, and we could find that we have got some liability might come, and something like more than 300 crores at the time. Also, what we could find that in 12 and 20 that the share of this particular net of S&E compared to the overall EBITDA, that was in fact is not going up. So it was 30% in 2012, and it's reduced to 21%. So we need to do something. It is a business as usual scenario, so that you need not to do many things. But if you have to keep this thing in mind, yes, you need to do certain things. And especially if you go back into the liability that might come onto you, you cannot remain there business as usual. That is the learning. Another thing which has come, that once we compared all these results of 12, 14, and 15, how the things have been changing over the period of time. So as you can, the last one, this bar, that in 14 it has gone up, the net value, which has come down in 15. So 16, that validation is going on, and we'll come to know where we are. So at least we'll know that whether we are doing good really or not doing so good, and what are the actual contributors for that. And we are also not very surprised that the fly ash, of course, is giving the biggest advantage, but the water is the next one. Because there's so much of recharges in the community gives us a clear-cut advantage, and that is giving the value. It's a bit of water, then we'll be having more of on the negative side. So that is what is there. Other things like alternative fuels and all that, of course, they are there, renewable energy. And on the negative side, CO2 emission, of course, because that is having some kind of implications now, because now we are part of this Paris Agreement, and we have got the NDCs given, or NDCs given now. So we might see that there is, for the cement sector, certain obligations for reduction of CO2 emission, which are direct legislation. And that has been there. Of course, as you know that for the carbon, it is the coal price, or the coal cost is there, and there is a levy, cess is there. But that was not real deterrent, as you can see, that if you need coal, you need coal, whatever would be the cost of it. But what is happening, because of the higher rate of coal, then you will see that what are the comparable costs of other fuels, right? So that kind of options one would start looking for. And this is the kind of thing that by 2020, that what are the levers and how much would be the reduction. All that could come out only because of this exercise, and also for water, how much additional we can have it. So these are some of the things. Now coming on to this product stewardship, because this is also a theme that many times we say that why not we have this costs of social and environment factored into the actual costs of the product, and they calls the product stewardship also. So we have not gone into the factoring of the costs, but what we have done is going for the label, which says that yes, we are a sustainable company, and we got this label after a lot of ups and downs in BIS, because the moment you say that I'm going to have some level beside the level of ISI here, then they won't agree, simply. They will say, no, we won't allow. Then is a lot of discussion with them, and it was 1.5 years it took to actually get this label, which can be put there. And of course, then we have gone with this. Now, of course, all these things you can find in our sustainability report as per GRI. And this is the 10th sustainability report, which is there on the website, which you can see it. And many of these initiatives, including True Value, you can find there. Now coming on to, let me, be just allow some more time in terms of going some of the other things which are there. And this is just an example. So there is this train comes to supply water. And what actually came out to be not the water cost, it is only the transportation cost with the railway charged. That was about 645 rupees per meter cube of water. So there is no cost of water was included, but just simply the transportation cost. Had you included that also, then you know that what is the actual cost which has been getting supplied to general public, to the, maybe you call it municipal supply. Now coming on to these 4 case studies, top ones, which I would like to touch upon very briefly. One is onto this World Bank study, which is not very recent, but then that gives the perspective that if you account these figures like social, environmental costs, where your GDP would be, and other studies as we can just go through. So what we want to achieve, there is another thing which has been there, the Sustainable Development Goals, which actually says that it's not only the economic growth of any country, but it has to be inclusive growth, where you have been, having various, the kind of a strata of the society also being part of that growth. And also what we can see, not the efficiency within the product life cycle, but maximizing efficiency across the life cycles. So that has been there, which is something which has been there. Another interesting thing I want to just show you, the unequal world. As you know that the top 87 individuals in the world, they command a wealth, which is more than, not many, but only 3.5 billion bottommost population of the world. And this is a very interesting thing which has come, that suppose one individual has to buy the entire carbon credit of the country. So where it would look like, how the scenario would look like. So you would need something like the top one, the black one is actually the individual's wealth or the worth, and the second one is the total carbon cost for the country, which is there. So it is 79.93 billion for China. So how the scenario looks like. So you need at least 2 Jack Ma to have enough money in the pocket to buy the carbon. But that may be an exception case, where Brazil, this gentleman can buy the entire carbon credit almost. The Russia one, of course, has got more wealth in the pocket to buy the credit. So he will still some money is left. Mukesh Ambani, of course, only 74% of his wealth can buy the entire carbon of India, right? Similarly, Canada, of course, this gentleman has got, not so much, but he has got a lot of things which he can buy at least twice of Canada, of carbon. And US, of course, again, Mr. Bill Gates can again buy the entire carbon. The US is the biggest emitter, but can also buy the entire carbon. And of course, all of that. So except China, 1%.
Sorry, Sandeep.
Sorry.
Hard
Okay.
stop, 1 minute.
Okay, so let me go through the all other slides very quickly. Now the World Bank study, which I was mentioning, here it says that the India where it is about 5.7% is the degradation, only environmental degradation. So if you are having a GDP of 7.5, what is your actual GDP? So you are just 1.8, right? And similarly, all others are also not doing very well in terms of if you factor in those costs. Of course, these are some of the other costs related to various kinds of things on environment on the loss side. Another interesting thing I just want to present is the Earth Overshoot Day. Do you know the Earth Overshoot Day? Which was started in 2010, and September end was. That means the Earth is able to utilize all its resources by the time. So it is September end in 2010. Then last year it was 8th of August. Do you know what is the Earth Overshoot Day was there this year or is going to come? Any idea? So it was 1st of August this year. So we have got, this is more and more advanced this day, right? Then, because time is really short, I'll just have very few slides very quickly in terms of that how the CEOs are looking at the sustainability world over. This report talks about more than 1,000 CEOs in 10 countries, 100 countries rather, and 25 sectors. And how the things have been changing has been depicted in this particular report. And some of the things related to accounting also, you can see that they say that they are able to accurately quantify the business case, though may not be the financial case, they are able to do, right? And 88% believe greater integration in financial markets will be essential to making progress. These are some of the other things that the circular economy has got a potential of $4.5 trillion by 2030. This is another study of the, which is called the Business and Sustainable Development Commission. And you will see that many of these things are there where a lot of erosion in this credibility of CEOs, like 80%, in 80% of the countries which were there, and because of many of these factors like sustainability. So
maybe we can
this is the
circulate
last
some
slide.
of this.
Just
Last slide. Okay.
This is the last slide. So if you factor in, finally, all your environmental and social costs, how this scenario would look like. So this one is there without the factoring in, and the bottom one is factoring in these things. So almost it is an inverted figure, from the top one. So many of these would run into losses if you factor in those things. But yes, there are things we can debate here. Have a discussion that what could be the things which we can do. But thank you very much for this opportunity.
Okay, so first of all, Jeremy, you saw the work KPMG did with Ambuja, and do you still believe that accountants can save the world? Because I'm an engineer, and I led that team. Okay, so just on that note, let me make it a little more simpler with 3 cases, and then I'm off 3 minutes. One is, think of a small unit coming on the side of the river, taking water from the river, utilizing it, letting it out, meeting all the regulatory requirements, but letting that water out. Now, that water is not the same as the water which is intake, right? There is downstream, there is a fisherman who used to catch about 10 fishes earlier. Now, after this unit has come, it has reduced to 8 fishes. Now, the 2 fishes lost, that doesn't feature into the company's P&L. Okay, there is an economic loss for somebody, but it doesn't feature into the company's P&L. Think about it, it's not a one fisherman, but a group of fishermen going there in front of this company, doing a dharna. Naturally, the politicians will take that side, and then the pollution control board is called in. What the pollution control board says, your emission norms we are changing, we are making it stricter. Now, what was an externality is forced to be internalized on the company. This is what we will be experiencing over the years. Stakeholder pressure, regulatory pressures, all those things is going to happen. What happened with the Ministry of Environment and Forest and Climate Change when they came out with the EPR regulation, extended product responsibility? What was an externality for people who were producing water in plastic bottles? Now, it was an externality. The disposal of that plastic bottle was an externality. It is forced to be internalized on them because the end product responsibility or the extended product responsibility says the final disposal of those plastic materials is the liability for the company now, and there are regulations. Same with the e-waste rules. Okay, so more and more of those externalities are coming to be internalized. In Bangalore, we all drive to our offices. If you tried driving in the night around 2 o'clock, you might reach your office, let's say, in about 15 minutes. And during your office hours, if you try to drive, you will reach in about an hour and a half. Because we have so many companies who run buses to fetch their employees. And I think between Wipro and Infosys together, they will be running about 600 odd buses. And that extra money which I spend from my pocket on the fuel is a loss for me, which I would have done in 15 minutes. I'm doing it in 1.5 hours. Now features in their P&L. It's a loss, it's an externality. But tomorrow, let's say there is a citizen's action and go to the corporation and say that this is not done. We say that, okay, let's put a surcharge on every buses that is run and say that that goes into something useful or reducing this thing or whatever it is. That's an externality which will be pushed to be internalized. So I will just summarize saying that the social and environmental accounting is in. And there is something which says that when it is time for something, there is a spurge of activities which happens around it. And that's exactly what we are seeing in this particular field. A lot of standards, guidelines, and all those things are coming, and there will be a convergence of all those things towards a proper accounting method. And this is a field which is kind of growing in a kind of a dramatic manner. And even the country's policies, whether it is government policies, the municipal policies, all those things will start factoring the environment and social accounting. Thank you.
Thank you very much. Good evening to all of you. Always a pleasure to be in IIM Bangalore. Okay, so there are advantages and disadvantages of speaking last. Advantages, a lot of it has already been said, so I just can sort of reuse some of that and summarize it. Disadvantages, what do I say new? So let me try my best. I'm going to start with a chart that Sandeep already showed you. I mean, in the sustainability eco chamber, this chart keeps coming up, which is this whole thing about humanity being in ecological debt. Various estimates peg it at, saying we need 1.5 Earths to support the human enterprise. But does it have a monetary value? Yes, it does. I mean, there's been a lot of work that's been done on this. The rate at which the Earth's ecosystem services is being depleted was estimated very conservatively at about $4 trillion per annum in 2011. This was a follow-up to a seminal study done in 1997 by a team of ecological economists led by Robert Constanza. It was published in Nature. And in 2011, the total value of natural ecosystem services was estimated at $125 trillion. A little earlier, in 2005, the TEEP study, which again Sandeep had referred to, which is the economics of environment, the economics of ecosystems and biodiversity, was probably the first exercise to put a value to environmental externalities. In 2011, for example, the top 100 externalities accounted for about 8% of GDP, or $5 trillion. These are among the first instances of an attempt to put monetary valuation to natural ecosystems. But it was nearly 100 years ago that the British economist Arthur Pigou first introduced this notion of externality and the idea of a Pigovian tax, which Santosh talked about, which is a possibility. Since then, this whole idea of externalities has been a controversial topic. There have been diverse perspectives and views from economists of different views on both sides. Ronald Coase had a certain point of view. Elinor Ostrom, the 2008 Nobel winner, had a different point of view. And of course, ecologists like Garrett Hardin of the Tragedy of Commons fame had their own voices on this. The valuation of externalities, however, came much later, with the 1997 paper being probably the first instance. It was an even later entrant to a lexicon of business, the whole notion of externality. And similar to the World Bank study that Sandeep shared, a 2012 study put the total costs of natural capital alone of global businesses to be 133% of its profits. In other words, if you account for these externalities, business in aggregate would be in the red. At a macro level, there have been several frameworks, again led by economists and political economists, to include the valuation of non-financial assets and liabilities alongside the conventional notion of the GDP. The GPI, or the Genuine Progress Indicator, is a good example. And there's a very dramatic slide which says that there has been a threefold increase in GDP per capita in the last 65 years, but the GPI has not only not increased, but it has started declining over the last 20 years. And the GPI is a very interesting example because it is at a macroeconomic, at a country level, that it tries to put a value to things like cost of crime, or on the positive side, to the value of household work, to the value of parenting, to the value of higher education, or negative costs of pollution, cost of leisure time loss, and so on. So at a macro level, it's a very interesting framework. And one of the interesting insights of this is that GPI peaks at a GDP per capita of $7,000, because essentially saying that human well-being doesn't really increase beyond the GDP per capita of $7,000. Okay, so therefore, in this larger context of society, what should business try to do when it tries to value externalities, whether it is positive and negative? There are various approaches. One of the most common approaches that is used by large companies is what Sandeep said, which is a life cycle approach, which is a set of environmental impact footprint of your entire life cycle. For example, this is Levi-Strauss, the Levi's jeans. What does it mean in terms of environmental impact across its value chain, whether it is in terms of global warming potential or land occupation or materials efficiency and so on. So this is fairly well established, well understood, and so on. But the monetary equivalent of it is something that's relatively more recent, probably the last 5, 7, 10 years. And the true cost of products is something that's a little bit more tricky, but then there's been good progress. For example, this attempt at finding out what is the true cost of a desktop or a laptop says that the true cost of a desktop is at least $69 over a retail price of $500, which means if you really have to internalize it, you should charge about $70 more. That doesn't happen. How should it happen? Whether it should happen through an external taxation or through internalized costs is a very interesting point of debate. Or take the big one, the true cost of fossil fuel energy, coal, gasoline, etc., actually amounts to about 6.5% of global GDP. But in some countries, the Middle East countries, for example, it can be as high as 18%. So that's really high. So now comes this question, why should business do this at all if there's so much of scrutiny, and why should it report externalities? I think the first thing is it's a core tenet of good governance. It shows that you're walking the talk on transparency. The second is it can be an ahead of the curve risk management strategy. Issues that previous speakers spoke about. It can address potential regulatory risks. What if government starts, imposing what is called a Pigovian tax on some of these things? Or a social analysis can identify reputational hot risks in your value chain. So it's a smart risk management strategy. Third is it can create a cycle of constructive pressure internally, a formal program of reducing negative externalities and expanding positive ones. And fourth, I think it can be a very powerful signaling value. It can send a strong message to all stakeholders and set up a model for others to follow. So at least 4 reasons why business should do this. But valuation is not uniformly easy. Some things are easier to value, some things are more. Relatively easy to value are things like greenhouse gas emissions, air pollution, deforestation, education infrastructure like buildings and laboratories, literacy, skills and training development. Relatively difficult to value are things like degradation of commons, biodiversity loss. Literacy might be a little easy, but good education is not so easy, and I'll talk a little bit about that because of our work in education. Or how do you put a value to diversity of workforce? How do you put a value to democracy and citizen empowerment? And things like that. Okay, so let's take the study of how do you value good education. So we've been working on education for about 20 years now. And if we have to characterize education in India, school education, there are 2 big factors, scale and diversity. Unparalleled scale, unparalleled diversity. Look at the statistics, 195 million children, 7 million educational functionaries, diversity, 441 living languages, minorities all over. And the issues, therefore, are several. One is even literacy. There's a big difference between male and female literacy. 81% male, 65% female. There are issues of retention. Just half of children reach 10th grade. Quality. 75% children in grade 4 can't read a grade 2 level text. Equity. There's a big delta in these parameters among girls and boys and tribal populations, minorities, and so on. And in the classroom, we all know this intuitively, learning is predominantly rote-based, marks-oriented. There's inadequate development of disciplinary understanding. Learning is often disconnected from the child's context. Knowledge is given by the teacher rather than being constructed along with the child. And teaching processes do not address diverse learning styles. So what is good education? At least 4 or 5 things. For example, the ability to develop critical and independent thinking, or the ability to combine multiple perspectives, systems thinking, social values, democracy, freedom, acceptance of diversity, an intergenerational perspective, individual values, integrity, courage, compassion. What about the pedagogy and learning environment? While adequate hardware is required, like buildings and laboratories, the software is critical. Software like the school effect, the school culture, teacher capacity, multilingual learning. Is the school inclusive and emotionally secure? So the question for us is, when we work on these issues, we don't work on infrastructure so much on some of these systemic issues. How do you value this? What do you put a value to this, right? So it's a difficult question for us, and I hope we get answers from Jeremy. So some of the key points, therefore, in this whole debate on the valuation game is cost of avoidance versus cost of repair. The famous Stern report on climate change 2007 said that it will cost only 2% of GDP to avoid runaway climate change, but it will cost 5.5% to restore the damage after climate change overshoot has happened. So what kind of cost do you take? There are a lot of people who say that you should not even try to quantify certain things like biodiversity. So this whole issue of intrinsic value versus instrumental value. How do you value CPR, common property resources, or public goods? They take refuge in Einstein's famous quote that not all things that count can be counted. And what about the now versus the future? What kind of discounting rates do you use? Some people think you should not even use a discounting rate. You should use an appreciation rate for the future. So this whole notion of intra versus intergenerational equity. And then questions of nexus and attribution. How do you do attribution? How do you account for the nexus of issues? If you look at ecology, sustainability, you have a whole lot of nexus of issues. Climate change is linked to water crisis, it's linked to food security. So how do you arrive at attribution, right? So these are some of the big issues. And now the last 5 minutes, what are we doing at Wipro? While we do the normal stuff of trying to report our environmental metrics, on energy, water, and so on and so forth, the last 2 years, there's a third year, we also publish our environmental profit and loss statement. So this is for 2015-16, says that our total environmental footprint is 11.5 billion Indian rupees. In terms of, on a normalized basis, that's 12.5% of our profits, which means if we have to neutralize this, our profits go down by 12.5%. This is published in our annual report. It's part of the sustainability report, so it's there in the public domain. Last 2 years, we've also adopted the integrated reporting approach, where we try to look at multiple capitals or multiple notions of value. So this is from this year's report: human capital, natural capital, intellectual capital, social and relationship capital. A lot of it is narratives. The numbers that we publish, we are not happy with because they're all output and outcome metrics. They're not really impact or value metrics. This is another snapshot which shows the interrelationship between all the capitals. So this is some of the stuff that we've been doing in terms of disclosures. Some of the learnings are that you have to socialize the idea gradually with key stakeholders, the CFO being one, the controllership team, the risk team, and so on. This takes time, and forcing the pace is not going to help. However, having said that, it's important to get started and not get lost in details of methodology and numbers. It's a direction that matters, not accuracy. Should use this initially for signaling on transparency and governance, and then gradually integrate it into operations and strategy. Public disclosures, we think, must be a strategic mix of the narrative and the numbers. Valuation statistics alone don't tell the whole story. Sometimes it can hide the most important issues. So So it must be combined judiciously. And value and capital cannot always be economic, so that's why the narrative is important. These are images from our biodiversity work in one of our campuses in Bangalore. Or, how do you, when you talk about diversity, you must talk about some numbers, but the narrative is also equally important. So essentially now we are also saying that along with all this, the mindset is important. The mindset should not be one of balancing out. You can't have a triple bottom line balance sheet where you say my assets and liabilities cancel out. You can't say that, there's a positive value to the jobs that I'm generating or my clean energy assets, but it's okay if my supply chain uses child labor. So the balance sheet of, multiple capitals or integrated value or whatever you want to call it should not balance at all. So let me end by paraphrasing Oscar Wilde, who said that it's not good to know the price of everything and the value of nothing. When it comes to valuation, yes, you must know the prices of many more things. Probably you should know the value of everything and the price of many things, and you should know the difference between the two. That's very important. Thank you very much.
Good evening. It's really easy to summarize the nice discussion that went along. Very insightful discussion, simply to say that I agree with everything that you said. And that would be right. But being an academic, then I have to add the natural corollary saying, however. And being here to kind of, not moderate, but just to kind of reflect on some of the issues they raised, I realized that, maybe I can raise some questions, which I necessarily don't have to answer because you have a set of experts there. But let me start with my assumptions. I agree that measurement is important. What you cannot measure, you cannot manage. And therefore, I think we started on the perfect note, Jeremy, by saying that, we must measure. And I think everything that can be counted, needs to be counted, cannot be counted. And that's why I think, Mr. Narayan, you're not Oscar Wilde, and I'm going to quote you every time. I think that is just perfect. And in between, we had these examples that we talked about. And I think they made some very important points. And let me start with a point that Mr. Narayan made, that sustainability accounting is really not something that's just about accounting. It's about behavior change. And that, I think, is a really, really important point. Even if you cannot force the pace, you still need to kind of initiate it, because that becomes a point of transformation for a corporation, and from corporation to society, going by what Sandeep said, corporations really rule society these days. But that aside, I think that the other important point, is the question that came up, should accounting be left to accountants? The answer obviously is no. Should sustainable accounting be left to sustainability experts and accountants? The answer obviously again is a no, because I think we really cannot account for everything. And let me just explain this, because when you tend to account, in a corporate sense, when you talk about true value and so on, you could measure the impacts, the negative and the positive, and you could feel pretty happy about it. But I was just wondering as I listened to you, you can account, but how do you kind of transfer the money? For instance, I could say the positive, I can map, as Santoshi was saying, the negative and the positive externalities, and then I can put a value to it. And the value Mr. Narayan would say is very debatable, and I would agree with him. Some things simply cannot be valued, but let's assume we value it, and we say that the net impact of destroying the common is not destroying, compromising on the quality of commons is basically some X amount of rupees. We have accounted for it, but we have not transferred anything to the society or anyone else. In other words, we have to go back to the old accounting principle. Cash is real, nothing else is real. And therefore, the next step in this would be to ask the question, from accounting to where do we go? How do we make sure that these negative externalities that are real costs to society get transferred back into society? And I think there we are going to hit a roadblock, because you can account, but when it really comes to transfer of wealth in real terms, in cash, I think corporations may not be willing, and that's where regulation and others need to come in. So that, I think, is really important to understand. Cash is real. accounting is numbers, and the two might not actually meet really. The other question I think that needs to be looked at, and two or three questions I'm going to very quickly close. And I think the point that you mentioned, that numbers need to be complemented with narratives, is really important. Once again, going back to the idea that not everything can be measured. But even more important, are we making enough efforts to really measure what is, or create right metrics? So if you could create an EVA, an economic value added, and accountants can use it, why can't we create a SVA, a stakeholder value added? And I know that is far more complex because stakeholders have different requirements and so on, but I don't really see, and I can see, Jeremy, in what you're doing is a step towards that, but we don't really see those metrics really coming out. So that is something to consider. The other question to consider is, how do we future-proof our reporting? Because many risks and uncertainties are still asset undiscovered. And the most common example is the value of biodiversity, but there are so many more things. And we are now talking about technologies which we don't understand, the impacts of which we don't understand, and therefore, how do we even account for it? We don't even know how to deal with them, and we don't even know what the impacts are going to be. So there are going to be all of those issues. There are going to be other questions. How much of this is going to be mandatory? How much should it be voluntary? What is the balance? And should there be a how should regulation shape that? Will it be self-regulation or something else? Would one size fit all? Should we have an inflexible reporting standard where we are talking about the need for flexibility because we don't understand many of the issues concerned and so on? Should we use regulation and reporting and disclosures as a way to drive innovation and improve performance and so on? All of that are questions, and I want to stop with one final question. We are talking about measuring the impacts, but I think we should also consider the impacts of measuring. And this is not a play on words, because what really happens is it's just not corporates that need to be educated. You could have corporates which have carefully accounted for their impacts, but I've seen corporates, and some of them sitting right here, who are really concerned about reporting on the actual impacts, simply because reporting the next step, let's say the subsequent step to reporting would be a claim to liability. In other words, simply put, if you know something, it can hurt you. What you do not know cannot hurt you because nobody knows what the impact is. And therefore, if you know nothing, you're invincible and cannot be hurt. And from that point of view, this is an oxymoron. You're saying don't count at all. Why I'm saying this, and I didn't mean that in a trivial manner. What I meant by saying this is, if you expect corporates to account and respond, you have to expect society to keep pace, to understand there are uncertainties, there are costs that still need to be, even though they may be reported, they may actually not be compensated by corporations. And there are regulators who need to understand this. So it requires a kind of movement from all sides. Otherwise, expecting the corporate to transform is probably not the right thing. I'm going to stop with that because we have some space for questions.
So how do you ensure an objectivity in measurement is my question, I guess, so that's the...
All that would be true of financial accounting as well, if it wasn't for the fact that we have international standards and assurance a requirement for auditing. If you didn't have international standards and the requirement for auditing, companies would produce company accounts which only showed profits. It's exactly the same. We can clearly do this by having an assurance framework of the information that people produce to make sure that the judgments in it are reasonable and that the positives are there, but also the negatives are there. And in fact, in practice, we are seeing companies that are more than willing to actually report on the negatives. So I think the culture's there to make sure everyone's doing that. We have to have international standards and an assurance framework. That's easy. We did it in financial accounting. We needed it there. We can do it for this as well.
But the nature of what you're trying to account does that make a difference? I'm just curious about, sorry to because what we're trying to account for is very, very subjective.
So everything in financial accounting, despite what you might think, no, the cash bit in a balance sheet is the easiest bit. Everything in a balance sheet after that is subjective and has estimates in it. And one of the heads of the, I can't remember, was the leader of the Institute for Chartered Accountants, said, the only thing you're sure of in a set of company accounts is the date, right? Even with the cash in that account, you have to be very sure in a big company that all the cash balances are been owned by the company. So even in that one, actually, there's some uncertainty. But if you get into subjects like contingent liabilities, there's masses of uncertainty and estimate going on in that. What has made them reasonable is lots and lots of practice and assurance. We simply haven't had that much practice in what we're doing yet. But I tell you, if we legislated for it, within 3 years, and every accountant around the world was suddenly having to produce this information with assurance of it and argue about it, we would standardize it so quickly. And waiting for a kind of research solution to this question will never get us anywhere. What will get us somewhere is everybody having to do it to a standard with external assurance. And standardization of those challenges will follow quickly, I think.
Is there anybody that you specifically want to
Yeah, I
address
have a
the
question for Mr. Srivastava. So, my name is Rajesh Mehta, and I am part of the Corporate Sustainability Department of SABIC. So, my question to you is, you mentioned about the price of carbon used for the EPNL accounting.
Right.
Why did you choose the China ETS scheme when Ambuja Cement's majority of operations are in India? And why did you specifically choose a 10 number? Because you know that for cement sector, like the cost of abatement of greenhouse gas emissions is way beyond $50 per ton.
Yeah. Yeah, first of all, let me say that it's not the carbon where it was put up, the price which we have taken is $30. We started with $25 in 2012. We have got now, whatever the things which have been given for 14, 15, that's for $30. And that was not the China ETS, right? That was just a representation which says that this is, equivalent of, the China, but that value we have not taken. Just to give some indication. Some of the things which have been there, especially onto these numbers, and that previous question also. Basically, this accounting is already part of the accountability, as you can see. Because herein, there is no legislation which wants us to do it. Still, you have done it, right? Certain things, fully agree that is very difficult territory in terms of assigning a number. Because globally also these numbers don't exist. Just like the TEEB and true cost and all, those are very established numbers. Some of them we can take it. But when it comes to the social costs, you won't find those numbers because these are truly, you can say, Indian or for the developing countries. But still you have ventured into that territory just to have some idea. As Jeremy was mentioning, just like in the financial accounting, you don't have a standard or standardized methodology. That is why what you can do is terms of relying the third party like KPMG in terms of then finding out something which you have done is fairly accurate. Is not exact those numbers which we can never say that these are the very, very accurate numbers. But after all, what you are doing here, you are benchmarking yourself year after year. When there is absence of a clear methodology.
Yeah, that's where the problem
This is a
lies
kind of
for-
a evolving situation where you have been find very few instances, even globally, that someone has done it. So those are there.
Yeah, that's where the problem lies for us as the Corporate Sustainability Department, because it's very difficult to convince the board if the numbers are so variable on how do they put targets in. Because the first question the board asks is, okay, you're going to measure it, but how do I put targets into place? Or do I need to actually put targets into place?
Yeah, so there are various ways of carbon pricing. And so you can use any of those methodologies to look into. And the common measure in terms of how we went into Ambuja is in terms of risk and opportunity assessments, and then that was converted into the price. And if they don't do this, so there are many things which are happening in India. The RPO, Renewable Purchase Obligation, is one. And the solar power tariffs were coming down. They were running the power plants at some point of time. So there is a modeling which we do in terms of risk and opportunity and come out with that numbers. So there is a way of doing it. We cannot explain all those things because that's the bread and butter for consultants, isn't it?
That's a good one. Okay. So on one hand, we're talking about assurance standards, and on the other hand, we are seeing that the ecosystem is not mature enough. But on the third hand, we are also looking at proprietary information. So I think it's just kind of reflecting the complexity of the field that we are engaged in. Yeah.
Good evening. I'm Padma Srinivasan. I have two questions. One to Mr. Srivastava. I want to ask him what is his definition of social value that they have included. I've seen a lot of parameters that he has put in his, included in his diagram somewhere. I want to understand, because the health hazards, the occupational hazards, what are the things that you have based your categorization on, the expenses that you have done?
Yeah. Yes, as I said, the social is a little difficult because you don't find those numbers out there. But still, we have got certain things like if you have got the health related, if you have got a hospital, right? And how many people it is catering to, right? And suppose you don't have a government hospital there, then what will happen? How much would be the health effects which have been there? So on the basis of that in absence of this hospital, how much people would be suffering, say, and having what is the cost of that. Similarly, when it comes to social occupational health, let us not forget the employees. That is also part of social. So you have got, say, if the accidents have been taking place, and how much would be that which is going to cost you over the period of time. So that is the parameter for health and safety which has been there. If you've got a lot of emissions which have been coming and affecting the health of the people, so there is a cost for the health of the people, which has been taken for these kind of assessments. But when it comes to the SEBI, which has been for the education, so how many people got employment? And of what range of employment they got? So someone is getting offset 25,000 a month. So then we have got over a period of time, how many people came out and what is the average salary of them? So this is the cost for the education.
No, that's why I asked you, what is the definition of social values we are including?
Okay, I am going to take the prerogative of a moderator to just say that there can be only one question. And please talk to the participants after the session is over. Yeah? And I believe you wanted to respond to it.
I think it's a really important question because we bandy around the word social value and we go, well, what do we mean? And I think, from our point of view as a community, it's changes in people's lives. Positive and negative changes in people's lives. Of course, then we have the question of, well, how do we know we've got all the changes in people's lives? And it's not going to be all of them. It's going to be the ones that matter. And again, I think this is why assurance is important, because you would need to have some comfort that that information has got all the changes in people's lives that matter. And they've then been put into these structures, these taxonomies. The question I've always got is, have we missed anything out? Is there anything that should have been in there that isn't in there? And with the best will in the world, unless there is an external process, there's always a risk, isn't there, that something would be missing. But that's how we think about social value, changes in people's lives.
I had a question. Yes. My name is Ram Nedumolu, and I want to first of all congratulate the speakers and the panelists on some excellent presentations. I thought they were really good presentations. So my question is, and I just want to pick up on, if accounting is, if this approach or the approaches here are meant to change practice, and this is taking place in the context of a crisis that's accelerating, right? So whether it's forest cover, whether it's species loss, whether it's water, if it's pollution. So you find the research suggests that it's accelerating. So if one were to think in terms of action that leads to change, and let's say the next 10 years is a critical decade, as has often been said. So my question to Jeremy is, at a global level, what are the three things, let's say, that need to take place to ensure that what's accelerating as a crisis can be dealt with? And then on the Indian panelist side, what are those three things that need to take place in India to essentially address the crisis?
So I completely agree. That's what it's supposed to do, create change. And the question is it? And more importantly, is it creating change fast enough? Because truth is, the world is facing increasing challenges with widening inequality and increasing environmental degradation. And if this is a solution, then we've got to act now. So what we're going to do to make that happen fast enough, well, I think partly it comes from the international community through the SDGs and pushing on things like how we measure changes in equality and how do corporate performance feed through into those changes, because that at that level then is a driver for some practice. Partly it's got to be through changes in legislation, and we would actively push for improvements in corporate reporting legislation to make this much more mandatory. Otherwise, we're relying on individual best practice. And whilst that might grow to everybody, we haven't got time for it to grow to everybody given the challenges we face. So I just stick with those two really in terms of drivers of global change. The international community around SDGs and the public legislation around what we expect of companies to report on. Well, as soon as we could change legislation, you know how difficult it is to to lobby for legislative change, because for some reason people aren't keen on legislative change, despite the fact that every time we have legislated for improved corporate accountability, stock market values have gone up, not down. So I don't know what everyone's frightened of really, but there you go.
Okay. You have a point? One thing that we need to do in India.
India, you can see that some of the things which have been coming very fast, and we can see which have been there. One is on the legislation side for various kind of, the parameters which were there, whether it's a cement sector or power sector and all. And then huge, you can say the commitment for the capex. We find ourselves to be something like 6,000 to 8,000 crores of rupees a year kind of thing. But what is mind-boggling is the power sector. And as per an estimate, that could be close to 1 lakh crore. Though maybe because of the FGDs and all which have been to be put it. So that is one. Secondly, on the water, which is going to be the other thing. And then the renewable energy. These are some of the things. Because you can see that even the fossil fuel-based power plants, people say that is committed after 2025, you won't see many fossil fuel-based plants are coming. And one interesting thing, if I just may say here, which I just came to know very recently, that when we talk about these, some of these are really disruptive. Especially like I was reading an article, or there was in the news, that the electric cars. And what was the news that after 2020, so it's about 3 years hence, 95% of the cars in US is only electric cars. Can you imagine? And for government of India is about 2032. That so just 10-15 years you won't have these cars. And then what they say that not individual cars, you will be going for that the what do you call it as an aggregator. So you have got more taxis. So you need not have those. Think about the parking places, and you have gas stations are lessening and all that. Anyway.
Good afternoon.
Narayan, you had something. No, is there one idea that, because I think that's an important question for, just a minute, please. For the community in terms of what it is, that is there a call for action in terms of how we take this forward? So I'd like, Jose, I'm coming to you on that. Yeah.
I think much as one would like it, I don't think there's one single answer to this. And depending on who you ask, the answers will be different. So I think some people will say, can't we legislate everything, and get everything done through legislation? But we know practically that some of the legislation works well, some of it doesn't. Things which are centralizable to some extent, like addition of renewable energy capacity, can probably work through that mode. A lot of things don't work in that paradigm of centralizability. So then what do you do for that? A lot of policymakers, even economists would say, it is doable. Technology can play a big role and governance can play a big role and so on. But if you ask deep ecologists, they will point to, the famous study done by Rockstrom and others, saying that we've already breached 3 of the boundaries, and ecosystems is something which can't be restored. So now you better start adapting, which is why even the Paris Agreement really is talking much more about adaptation rather than mitigation. So that could be another point of view. Better live with the reality that you can't really restore a lot of damage that's been happened and learn to adapt. So the answers are going to be very different depending on who you ask. And there's a lot of uncertainty to this. I don't claim to know the answers.
Good. I think it's the plurality which probably poses the challenge for all of us.
So just one quick point, I think I agree. Depending on who you ask, the answer will be different. But I think one danger that we must be aware of is the danger with implementing ill-conceived solutions. And let me give you a simple example. If you take renewable energy, which everybody talks about, 20,000 megawatts to come on stream. Let's talk about solar, for instance, 20,000 megawatts of solar. sometime in the future. Now, most people don't account for the fact that these solar panels need to be recycled, just as an example. So the solution turns out to be the problem. And I think that is going to be our biggest challenge, because some of the problems are simply not invisible, and some problems that will emerge are inherent in the solutions that we are now proposing. And this I think happens with many new technologies. One really needs to be cautious about that.
That's the last question,
Yeah.
but
Good afternoon.
you have a question or a comment? Can I just hold on after his question, please?
Yeah, my name is Joseph Martin. I'm promoting a sustainability consulting firm based out of UAE. My question is, we are dealing with this question of assurance and change in the behavior. Do you think a single entity can do the full assurance, or a completely stakeholder-driven assurance on specific aspects, depending on the stakeholders' interest? That is going to drive sustainability in the future, especially because you have seen success of technologies like Uber, which is actually influencing the entire transportation pattern of a city. So I think instead of we thinking about bringing assurance frameworks and the role of assurance, if you shift that focus to customers and investors or society to do the assurance and reporting, that can actually make much faster changes in this sustainability field.
Yes, a bit. I think that they can help on that, but I'm really nervous of any kind of bit which goes, oh, we can do assurance through this kind of other thing, and a mixed thing, because it won't be assurance for people who are expecting to make decisions about resource allocation. It will just not help them make decisions. So whilst all those bits have a role to play, and multi-stakeholder assessment of materiality is really important, I agree with you, it's doable through assurance frameworks. They exist. And I think that in the end is going to be the bit that will lend credibility to any of this other information that's being produced in a way that makes it usable. And the risk otherwise is that we find all these kind of slightly more vague assurance which don't really provide assurance enough.
Another assurance?
I know. So coming from KPMG, we can do it all. So, that's a simplest answer, but really answering you to your question is, I'll take from what Jami said. We can use the subject matter experts, but there is a clear process by which you do the assurance. So that need to be followed in that particular due course. But on specific areas, we can use the subject matter experts.
Yeah, good afternoon. I am Rakesh Kasba from Aten Civil. Yeah. I am in sustainability housing construction, particularly for Mr. Srivastava. Also, I would like to involve Mr. Narayan. We know 300 billion tons of carbon dioxide are given by cement alone. Are we doing something as a slight replacement of cement so that the construction could become a little more sustainable?
I would not say that cement could be completely replaced, because of course that would be the future. That much I can say. Day will come, the disruption. But as of now, I cannot say that. You have already found some substance which can actually replace cement completely. The only thing which you have been doing is you have got various grades of cement. You have been utilizing a lot of those wastes which have been actually utilized for making cement. So you have got less of resources, less of fuel, and all these kind of things which have been happening, and happening fast also. As you can see that this alternative fuels, 2 or 3 years back it was less than 1%. Today it stands more than 4.5%. So the thing is that the things have been coming very fast. But I don't have a direct answer to you.
I think I have a direct answer. There can be disruptions, and cement industry has to look into that as well, because it's simply but calcium carbonate, And there has been technologies, if you look at the biomimicry as a subject, there has been kind of studies where they can produce from seawater calcium carbonate by absorbing the atmospheric CO2. So you are solving the atmospheric CO2 problem and using the coral formation as mimicking the coral formation, you produce CO3 and produce cement out of it. There are studies which show that it's only that scale is a matter. The day the scale starts, cement industry is into trouble.
Okay, and your last question.
Yeah, my name is Dipankar, and I'm basically an educationist. See, we can measure literacy, but we can't actually measure good education. We can measure, for example, a sustainable income, but we actually can't measure happiness. So, are we saying that maybe some beginning has been made, but there is a very, very long way to go, or perhaps we are still kind of hoodwinking ourselves with maybe measuring wrong things or not looking in the right direction?
So which is why the point that I was making, and when it comes to education, and that's the field that we are somewhat familiar with, not fully, school education. We don't even try to measure all the things that we talked about, which is good education. There have been attempts to measure literacy, school enrollment and things like that, using methods that are primarily, economics based. How does it translate into future incomes, and apply a appropriate discounting rate, and so on and so forth. So, I mean, probably it is possible to do something like that. But how do you put a value to good education, or the fact that people are more responsible citizens than if they didn't have good school education and stuff like that? That's very difficult. I don't think we've even tried to look at that path.
Well, last time I checked, Harvard had put a value on a good education, quite simply. And I think happiness is another example of this, is that there are lots of ways of measuring happiness if you ask people and you're willing to take some kind of good enough approach to understanding whether people's happiness has changed. We do it all the time when we go and buy things. We buy things because we like them. They've made us a little bit happier that you go and buy whatever it is that you went and did and thought, I like the new car, or I like the new whatever. So the markets, private companies, do that all the time. They measure happiness. They do it through being specific about who they're doing it for, with particular things that they're doing it. And we have lots of other scales and methods that we can use. Your point is key here. It's not about being accurate, because you'll go mad trying to get to that point. It's about the direction of travel. Are we making people happier than we did last year? As long as we have a consistent way of thinking about that over time, we will have a good enough indication that we've been successful or not. But if we try and get perfection in these things, then I think we'll lose the will to live, and we'll stop in our tracks before we get far enough.
Okay, good. And
rather, I have a question from you, and coming from the happiness. If I'll ask this question to all of you, that are you happy? So what is your reply? How many will say yes? How many? No, because I'll just come to this point which you have very rightly made. How many are happy? Two, almost 60-70%. In fact, there is already a World Happiness Index, And what was, again, very surprising, that we are not doing very well there. So out of 150 countries, we are just maybe 120 or 22. So if Norway and Sweden is number 1, 2, we are 120, right? But what is, again very intriguing, that Bangladesh, Nepal, Sri Lanka, they are ahead of us. Even Pakistan is ahead of us. So that was something.
On that note, let me just leave with one thought that's just kind of there, which is we can obviously see that unlike many other panel discussions, there's still a lot of tentativeness, there's still a lot of ambiguity, and obviously there is a lot of thinking for us to do. It is complex, okay? Complex because it's interconnected, complex because it is about a future that many of us are unable to predict with any degree of certainty. Given all of this, I think what it just leaves for us to think about is maybe we need more conversations around this than many other areas where we seem to have slightly more definitive clarity. And on that note, I want to thank the panelists for a great panel, which left more questions than answers. Thank you. Thank you very much.
As Vasanthi has already mentioned, that gratitude to the panelists who've done a wonderful job of at least, bringing the problem to the fore. And as I think the British Prime Minister said, to be aware that you are ignorant of the facts is a great step towards knowledge. Benjamin Disraeli, I think, said that.